Right now, millions of investors are sitting on the sidelines, parked in the safety of high-yield savings accounts, money market funds, and short-term bonds. They're waiting. They're waiting for the Federal Reserve to finally wave the white flag, declare victory over inflation, and officially signal a pivot toward lower interest rates. But here is the hard truth. By the time the Fed makes it official, the biggest gains may already have been made. Think about it. The market is a forward-looking machine. It simply doesn't have a price today. It constantly tries to price in what the economy and interest rates could look like 6 to 9 months from now, while the crowd is waiting for confirmation. Investors who position early may already be rotating out of cash and into high-quality assets that have been beaten down by higher rates. And that's exactly where today's opportunity comes in. For the last couple of years, dividend stocks, the traditional bread and butter of the income investor, have been treated like yesterday's news. But a massive rotation could be brewing. Today, we're breaking down 5 undervalued dividend stocks that the market has quietly left behind. These aren't simply stocks with high yields. They're companies with established businesses, significant cash flows, and potential catalysts that could become more important if interest rates eventually move lower. Because the biggest opportunity in this market may not be the stocks everyone is screaming about on social media. It could be the 5 names we're revealing today. The names that have been pressured by the current rate environment and could benefit if the tide begins to turn. Let's start with the contrarian opportunity. To understand why dividend stocks could be positioned for a comeback, we have to look at why they fell out of favor in the first place. For years, cash was considered almost useless when interest rates were near zero. But then the Federal Reserve aggressively raised interest rates. Suddenly, investors could earn attractive yields from money market funds, treasury bills, and high-yield savings accounts without taking the same level of equity risk. At one point, investors could earn around 5% from relatively low-risk cash alternatives. That created a massive headwind for dividend payers. Why buy a utility or consumer staple stock yielding 4% when you could potentially get 5% from a short-term treasury with far less price volatility? Institutional investors had a powerful reason to move capital towards safer income-producing assets. But here's the problem. That trade can work extremely well while rates are high. It doesn't necessarily work as well forever. When interest rates begin moving lower, the mathematics can change. Suddenly, those boring dividend stocks can become much more attractive. Lower rates can reduce financing costs for companies with significant debt. Lower bond yields can make dividend yields more competitive. And investors who still want income may begin looking beyond cash and government bonds. The institutional rotation is like a giant ocean liner. It takes time to turn, but once it starts moving, it can create a massive wake. And investors don't necessarily want to wait until the ship has already turned 90 degrees. Now let's talk about the high cost of waiting. There's a common misconception that investors should wait for the all-clear signal. But in the world of investing, the all-clear signal can also be the most expensive price tag you'll ever pay. Markets often move based on expectations rather than confirmation. If investors suddenly become convinced that rates are heading lower, dividend stocks can move before the Federal Reserve actually cuts rates. That means if you wait until the headline says the Fed cuts rates, you could potentially miss part of the initial move. And that's exactly why the current environment is so interesting. As of August 2026, the outlook isn't a simple one-way bet toward rate cuts. Inflation is still above the Federal Reserve's 2% target, while economic growth and employment data are creating competing signals. Recent reporting also shows disagreement among Fed officials about whether rates should move higher, stay where they are, or eventually decline. So this isn't about pretending we know exactly what the Fed will do next. It's about understanding what could happen if the rate environment eventually becomes more favorable for dividend-paying assets. Furthermore, staying entirely in cash carries its own risk. That's called opportunity cost. While your cash sits there earning interest, inflation can continue reducing your purchasing power, and you're potentially missing capital appreciation if risk assets begin recovering. We aren't looking for just a yield. We're looking for a total return. That's the combination of income from dividends and the potential for the underlying stock price to appreciate. But before we get to the list, Let's be clear. We aren't simply looking for the highest yields. A 10% dividend yield isn't automatically a bargain. Sometimes, an extremely high yield is actually a warning sign. It can mean the stock price has collapsed because investors believe the dividend itself may be at risk. That's what investors call a yield trap. At Liberty Wealth Academy, we use a broader framework. We look at dividend sustainability. Is the payout supported by the company's earnings and cash flow? We look at free cash flow. Because ultimately, a company needs real cash to continue paying shareholders. We look at balance sheet strength. Can the company handle its debt if interest rates stay higher for longer? We look at valuation. Are investors paying a reasonable price relative to the company's earnings, cash flow, assets, and historical valuation? And finally, we look at the catalyst. What specifically could make the market change its opinion of this company? With that framework in mind, let's dive into the countdown, starting at number 5. Number 5 is NextEra Energy, ticker symbol NEE. NextEra Energy is one of the largest utility companies in the United States, while also having a massive presence in renewable energy, particularly wind and solar generation. And that combination makes NextEra especially interesting in a lower rate environment. As of the latest available August 2026 market data, NextEra has been trading in the mid-80s per share. Recent August trading put the stock around $85 to $87 per share. Its dividend yield is roughly around 3%, depending on the exact share price used. Now, you might look at a 3% yield and say, that's not exactly a massive dividend. And that's true. But NextEra isn't being selected because it has the highest yield on this list. It's being selected because of the combination of income, utility stability, renewable energy exposure, and potential long-term growth. Utilities are often described as bond proxies. When interest rates rise, investors can demand a higher return from utilities because safer bonds are paying more. That can put pressure on utility valuations. And NextEra has another issue. Its renewable energy operations require significant capital investment. Building power infrastructure isn't cheap. The company has to invest billions of dollars into generation, transmission, and other infrastructure. That means financing costs matter. If rates eventually decline, lower borrowing costs can become a meaningful tailwind. And if bond yields decline at the same time, a dividend yield around 3% can become more attractive relative to fixed income alternatives. That's the pivot benefit. But there is a risk. If inflation remains sticky and rates stay higher for longer through 2027, the recovery in rate-sensitive utilities could take longer than expected. Regulation is another major risk. Utilities operate in heavily regulated markets, and if companies can't recover higher costs through approved rates, margins can come under pressure. So the verdict on NextEra is simple. This is not the highest income stock on the list. It's a defensive foundation with a potential growth kicker from its clean energy exposure and a possible benefit if the cost of capital eventually falls. Now let's move to number 4. Number 4 is Realty Income, ticker symbol O. If you've ever heard the phrase the monthly dividend company, you're talking about Realty Income. Realty Income is a real estate investment trust that owns thousands of properties leased to businesses across different industries. The company's appeal is straightforward. It collects rent from tenants and distributes a significant portion of its cash flow to shareholders. As of the latest August 2026 market data, Realty Income has been trading around the low 60s, with recent trading around $62 to $63 per share. At that level, its dividend yield is roughly around 5.5%. And that's where this stock becomes particularly interesting. Realty Income pays its dividend monthly. The company has also built an extraordinary dividend history, with more than 25 consecutive years of dividend increases. But here's the reason the stock has been under pressure. Real estate investment trusts are extremely sensitive to interest rates. When rates rise, borrowing becomes more expensive. And because REITs rely heavily on debt and equity markets to acquire additional properties, higher financing costs can make expansion less attractive. At the same time, investors can compare a REIT's dividend yield with government bond yields. If treasury yields are high, a REIT may need to offer an attractive yield to compensate investors for taking additional risk. That's why a change in the interest rate environment could matter so much. If the 10-year Treasury yield falls, income investors could once again become more interested in high-quality REITs. And Realty Income has something many smaller REITs don't have: scale. It has built a huge portfolio across thousands of properties and tenants. The company has also continued investing despite the difficult rate environment. In the second quarter of 2026, Realty Income reported that it invested approximately $2.6 billion at an initial cash yield of 7.3%, showing that the company continues to find opportunities even in a challenging financing environment. The bull case is that you're buying a massive portfolio of income-producing real estate while the stock remains below its recent highs. The bear case is that a severe recession could hurt even strong tenants. If consumer spending collapses, some retail and commercial tenants could experience financial stress. And if rates remain elevated for much longer than expected, REIT valuations could remain under pressure. But if you want monthly income and a company that could benefit from a more favorable rate environment, Realty Income deserves attention. Now let's move to number 3. Number 3 is Pfizer, ticker symbol PFE. Pfizer is completely different from the first two companies. This is a global pharmaceutical giant that has been struggling with a post-pandemic revenue reset. During the COVID era, Pfizer generated extraordinary revenue from products such as its COVID vaccine and antiviral treatment. But those revenues eventually declined. That created a major hole in the company's financial results and changed the way investors viewed the stock. As of August 2026, Pfizer has been trading around the mid-20s, with the stock closing at $26.80 on August 13th. The dividend yield is roughly 6.5% to 7% at recent prices, depending on the exact share price and dividend calculation used. Now that yield is huge compared with NextEra. But remember what we said earlier. A high yield can also mean high risk. The market is demanding a large yield from Pfizer because investors have legitimate concerns. The company faces declining revenues from certain legacy products, patent expirations, and the challenge of replacing pandemic-era revenue. That's the bear case. But there is another side to the story. Pfizer has used its enormous cash-generating capacity to invest in acquisitions, research, and new products. The company is trying to build the next generation of revenue sources before its older products lose exclusivity. And that's why this is a value turnaround thesis. You're not buying Pfizer because the business is growing at technology company rates. You're buying it because the market may be pricing in a large amount of pessimism. And if management successfully rebuilds the pipeline, the valuation could look much more attractive in hindsight. The pivot benefit is slightly different here. Healthcare is generally considered a defensive sector. If the Federal Reserve eventually cuts rates because economic growth slows, investors may look for companies with relatively resilient demand. People don't stop needing medicine simply because the economy slows. That's the bull case. You're potentially getting a world-class research and development organization at a relatively low valuation while receiving a substantial dividend to wait. But the risk is serious. The patent cliff. As major drugs lose exclusivity, Pfizer has to replace that revenue with new products. If acquisitions fail to produce the expected results, or if the pipeline doesn't deliver enough successful drugs, the stock could remain stagnant for years. So the verdict is clear. Pfizer is the deep value play on this list. It offers the highest yield among these 5 names, but it also comes with significantly more company-specific risk. Now let's move to number 2. Number 2 is VICI Properties, ticker symbol VICI. VICI is one of the most unusual REITs on the market. Instead of focusing primarily on traditional office buildings or shopping centers, VICI owns the real estate underneath major gaming and entertainment properties. That includes some of the most recognizable properties on the Las Vegas Strip. And here's what makes the business model so interesting. VICI doesn't need Las Vegas consumers to directly pay it every time they walk into a casino. Instead, it owns the real estate and leases that property to major gaming operators. As of mid-August 2026, VICI has been trading around $26 per share. The stock closed at $26.34 on August 13th. Its dividend yield is roughly 6.5% at recent prices. That's a significant yield. And the business has another important characteristic. Its leases are generally long-term, and the portfolio has very high occupancy. This creates relatively predictable rental cash flow. Unlike an office REIT dealing with empty buildings and the work-from-home trend, VICI's properties serve a very specialized purpose. You can't simply build another Caesar's Palace next door. The location, licenses, infrastructure, and operating businesses create significant barriers to entry. That's part of the competitive advantage. The pivot benefit is straightforward. As a REIT, VICI can benefit if financing conditions become more favorable. Lower rates can reduce the cost of capital and potentially make acquisitions more attractive. But VICI can also benefit from a broader wealth and consumer confidence effect. If economic conditions stabilize and consumers continue spending on travel and entertainment, gaming properties can remain strong. The bull case is a specialized real estate portfolio with high occupancy, long-term leases, and a substantial dividend. The bear case is concentration. VICI is heavily exposed to gaming and leisure. If a major recession, travel disruption, regulatory problem, or industry-specific shock hurts casino operators, VICI could feel the impact. And if interest rates stay high, the valuation of REITs can remain under pressure. Still, VICI offers something very attractive. You get real estate exposure without having to bet on the future of traditional office buildings. And for investors who want a combination of income and potential capital appreciation, VICI is one of the most interesting names on this list. But now we've reached number one, and this stock is different from all four of the others. Number one is Brookfield Asset Management, ticker symbol BAM. Brookfield Asset Management is an alternative asset manager focused on areas such as infrastructure, real estate, private equity, and other long-duration assets. The company makes money by managing capital for other investors. And that's why it could be such an interesting way to play a changing interest rate environment. Brookfield Asset Management has been trading in the high 40s in recent U.S. market data, while the company's quarterly dividend was recently declared at 50 cents per share, which works out to approximately $2 per share annually before any future changes. That places the dividend yield in the roughly 4% range around recent prices. But the dividend isn't the main reason BAM is number one. The real thesis is capital flows. Brookfield specializes in exactly the kinds of assets that have been heavily influenced by interest rates: infrastructure, real estate, private markets, long-duration investments. When rates rise, valuations for these assets can come under pressure. When rates stabilize or fall, the mathematics can change. And Brookfield doesn't necessarily need to own every asset itself to benefit. It manages capital. That means when investors become more comfortable putting money into infrastructure, real estate, private equity, and other alternative investments, Brookfield can potentially benefit from increased fundraising and fee-generating assets under management. The company has continued raising significant capital in 2026, with recent reports highlighting strong fundraising momentum and roughly $98 billion raised during the first half of the year. That's why the pivot benefit is so interesting. When rates fall, the value of certain assets can recover. Financing conditions can improve. Deal activity can increase. And institutional investors may become more willing to commit capital to private market opportunities. Brookfield is essentially positioned in the middle of that ecosystem. They are the deal makers. And lower financing costs can become fuel for the engine. The bull case is that Brookfield has a scalable, capital-light asset management model, a large platform, significant fundraising capability, and exposure to multiple alternative asset categories. The bear case is complex. Brookfield isn't a simple business to analyze. Its corporate structure can be complicated, and investors need to understand the difference between the asset management company and the underlying businesses and investments associated with the broader Brookfield ecosystem. Another risk is a credit crunch. If financial conditions suddenly deteriorate, deal-making can freeze, fundraising can slow, asset valuations can fall, and the stock can experience significant volatility. But this is our number one pick because it doesn't simply benefit from lower rates. It can potentially benefit from the market activity that follows a major shift in the rate environment. And that is a very different kind of opportunity. Now let's compare the 5 If you're primarily looking for defensive income, NextEra Energy and Realty Income are the more straightforward choices. NextEra offers utility exposure, renewable energy growth potential, and a dividend around 3% at recent prices. Realty Income offers a much higher yield, around 5.5%, along with monthly dividend payments and a long history of dividend increases. If you're looking for deep value and are willing to accept more risk, Pfizer is the standout. Its yield around 6.5 to 7% is extremely attractive, but that yield comes with significant concerns surrounding its post-COVID revenue reset, patent expirations, and future pipeline. For growth and income, VICI Properties and Brookfield Asset Management offer a more unusual combination. VICI provides specialized real estate exposure with a yield around 6.5%. Brookfield Asset Management offers exposure to the alternative asset management industry with a dividend yield around 4% at recent prices and significant potential leverage to capital flows and asset values. But now we need to talk about the biggest mistake investors could make. And that mistake is going all in simply because you believe the Fed will cut rates. Don't do that. Rate cuts don't automatically mean stocks go higher. In fact, sometimes the Federal Reserve cuts rates because something is going wrong in the economy. If the Fed cuts because unemployment rises sharply, consumer spending collapses, or a recession becomes severe, even great dividend stocks can fall. That's why the thesis isn't simply Fed cuts equals buy everything. The real thesis is much more nuanced. Look for quality companies. Look for sustainable dividends. Look for reasonable valuations. Look for balance sheet strength. And then identify companies that have a legitimate catalyst if financial conditions improve. That's the difference between investing and simply betting on a headline. The goal isn't to time the market perfectly. It's to build positions in companies that are strong enough to survive the storm and potentially benefit when the environment improves. And remember, valuation still matters. Don't chase a stock after it has already jumped 20% simply because someone on social media says a rate cut is coming. Now let's recap the 5. Number 5 is NextEra Energy, the utility and clean energy play. Number 4 is Realty Income, the monthly income play. Number 3 is Pfizer, the deep value healthcare turnaround. Number 2 is VICI Properties, the specialized real estate income play. And number 1 is Brookfield Asset Management, the alternative asset management powerhouse. The opportunity right now isn't about pretending that we know exactly when the Federal Reserve will pivot. The current rate outlook is uncertain, and policymakers remain divided. The opportunity is about understanding what could happen when the market begins to believe that the era of restrictive monetary policy is coming to an end. Because markets don't wait for the press conference. They anticipate, they reposition. And sometimes, by the time the average investor feels comfortable enough to act, the market has already moved. That's why dividend stocks deserve attention. Not because every dividend stock will explode. Not because every high-yield stock is undervalued. And definitely not because rate cuts are guaranteed. But because periods of changing interest rates can create enormous differences between the companies that are prepared for the next environment and the companies that aren't. Investing isn't about being right every single day. It's about being positioned intelligently for the big shifts before they become obvious to everyone else. If you want to build a portfolio that stands the test of time and generates income while you sleep, you have to look beyond the obvious names. You have to understand the fundamentals. You have to understand the risks. And most importantly, you have to be willing to think differently from the crowd. If this breakdown helped you see the dividend market through a different lens, do us a favor and hit that like button. It helps us keep the lights on here at Liberty Wealth Academy. And if you haven't already, subscribe to Liberty Wealth Academy so you never miss our deep dives into the strategies, companies, and market shifts that can actually move the needle for your wealth. Now I want to hear from you. Which of these 5 stocks are you watching most closely? Is it NextEra Energy, Realty Income, Pfizer, VICI Properties, or Brookfield Asset Management? Or is there another dividend stock you think we completely missed? Drop your answer in the comments below. I read as many of them as I can. And in our next video, we're going to look at the hidden risks in the technology sector that most investors are completely ignoring. Because while everyone is watching the biggest technology companies race higher, there could be risks developing underneath the surface that aren't getting nearly enough attention. You won't want to miss that one. Until next time, keep your eyes on the fundamentals, stay focused on the long term, and keep building your legacy. This is Liberty Wealth Academy. See you in the next one.